Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The quarter ahead for stocks is earnings, the Fed, more economic data loom, especially large, not to mention any potential surprises, of course. The Investment Committee revealing their playbooks for the months ahead. Joining me for the hour today, Carrie Firestone, Steve Weiss, Jason Snipe, and Jim Leventhal, both here with me at Post 9. Let's check the markets on this final day of the quarter. You just heard Carl say the S&P is looking for 4,100. Will it find it today on this final trading day of the first quarter? We shall see. NASDAQ, big shock, outperformer yet again. It's up better than 1%. All right, Jim Leventhal. So goes Q1, so goes the rest of the year. That's how we discuss this to start. Since 1980, S&P has posted a Q1 gain 28 times. Only 4 of those times has the index found itself posting an annual decline that same year. Got a little seasonality on your side in April. What do we think? And a week in which you've gotten a little more negative.
Just a scooch.
I don't care.
Just a scooch.
For you, that's a
listen, I won't back away from it. I've got to respect. What I've really got to respect is that the Fed just doesn't seem to get it. And I'm not going to belabor this point, but yesterday you and I were on, and Fed President, I think it's Boston Collins, talking about tightening more, and I'm flabbergasted. So I'm not even going to spend time on that.
Does that mean does that make you more negative about what lies ahead?
Yeah. Because first off, what they're doing is they're snatching defeat from the jaws of victory, Scott. They've got inflation going in the direction that they want it. I don't care if you look at average hourly earnings in the labor report, the CPI, the PCE today. It's just going in the direction that it's going to go. And you know what? Not all of the effects of the Fed have been felt yet of the last year's worth of tightening, but they just don't seem to get it. And it doesn't matter what I think, okay?
No, you know what? It does, because you're not alone. In fact, we just had our Delivering Alpha survey, right, looking ahead to the second quarter. The biggest risk to the market in 2023 will be, what was the number one answer? Jason Snipe, missteps by the Fed. Is the Fed moving too fast on rates, we asked? Yes. 45% said yes, time to slow down. So we got worries that the Fed is going to make a mistake. They're going to misstep, and that is going to cap what happens in stocks in the months ahead.
Well, there's no doubt about that, Scott. Obviously, they went too far on the front end, right? They talked a lot, all the transitory language that we experience, and it's likely that they will over-tighten. But I'll tell you what was positive for me as it relates to PCE today. This was February numbers. This is before the banking crisis that we've experienced over the last couple of weeks, and those numbers were positive, cooling slightly. I do think the Fed will respond. Listen, we have some time to the May decision, and I do think this will play into the decision-making that lies ahead for the Fed going forward.
So, Weiss, you know, we asked also what the S&P is likely to do. 68% of those who answered said has more room to fall. Presumably, you would fall into that category, would you not?
I would. So it's all about the timing. And the market is very event-driven, event meaning economic releases, Fed meetings, et cetera. So right now, though, you're in a period where there's basically no news. So you're in a quiet period for companies, which means no buybacks, which means no pre-announcements if you're on a calendar fiscal. And then you don't have a Fed meeting for a while, and you don't have really important economic data, which are inflation numbers, for a couple of weeks.
Well, I mean, you had it today. You had it today, right? You thought that the PCE day was going to be a big day. Lo and behold, it comes in cooler than expectations. No shock at what the market's doing here. Dow's good for 270. S&P trying to get to 4,100. NASDAQ leading yet again.
So it is a big day. So it was a binary. I said it'll be binary. And so if the numbers were showing hot inflation, you would have seen a big flush in the market. If it showed really muted, a non-event as we saw it today, or showed a significant reduction in the pace of inflation, then it would be off to the races. But it continues to be consistent, the market, in that it's just finding that sliver of good news to continue to push the averages higher. And I think that's going to be the case until you get into the heart of earnings.
You know, Carrie, Citi double upgrades U.S. equities today, by the way. We upgrade U.S. to overweight along with the global tech sector. We downgrade Europe and global financials to neutral given their cyclical nature. So if you voted in our Delivering Alpha survey, and maybe you did, I'm not sure, 68%, as I said, say the S&P has more room to fall. Do you fall into that camp? Or are you in the Citi camp, which says, you know what, it's time to upgrade U.S. equities?
Well, Scott, you know that at one point on a show, I sent you a text that said the most positive thing about the market is how negative everyone is. And now, 3 months into the year, we have the NASDAQ up, mid-teens. You've got technology stocks and communication stocks up, high teens. I mean, who would have expected that among the camp that said we had to get to new lows again? And what we've seen, though, is the effect of all of the interest rates that we've had are behind us. And now maybe we have 25 basis points left. But at that point, it's unlikely that we're going to see more.